this evening. Is this working good? Delighted to see you all and to be at this event tonight. Now I'm going to have the challenge. My team at Cooper Parry, we help clients sell their business, basically. We help them buy businesses as well, but the big part is about selling businesses. Is this better? Yeah. Great. Click the button and it turns it on. I should have worked that one out. As you're looking at selling the business, one of the big things we benefit, clients benefit from driving the growth through that business, increasing the value of the business as they go through. And we've just broken a couple of things down here in certain parts. There's number one, we talked about robust internal controls. So when anybody's buying a business, they want to make sure that it will all stack up together. That what they're paying for a business is substantiated by the numbers, by the business, by the activities within the business. So hugely important to really understand the data, the numbers, what makes up the business. Create KPIs which measure what is going on in the business. And then use those KPIs to make the strategic decisions about the continued growth for the business and really present that to buyers. I haven't quite got as detailed graphs as Ewan had, and they won't be as good as Mark's. He'll be explaining lots of graphs, I'm sure, to you later. Very, very simply, so we talked about as part of that sort of build-up of information and so on. And why is it important? Well, data is fundamental to decisions made by buyers of businesses. Private equity in the UK market represents well over 50% of every single deal that happens in the UK mid-market. Private equity are massively data hungry. They're hugely analytical people. Some of them will invest on gut feel, but they'll get somebody to make sure they can back it all up with all the numbers. And one of the interesting things, just looking at the investments over the last few years, now well over 2/3 of those investments made by private equity are for bolt-on acquisitions. So it's not just the primary deal, the first deal they invest in, backing your business. They're then going on to buy additional businesses to add alongside. We've got a great example at the moment. Cooper Parry is on this journey. We have a private equity backer. We've made acquisitions. We're now a much bigger business and moving forward as one business going forward to who knows what the next stage of our development will be. So bolt-on acquisitions are a really important part of that growth strategy for a number of businesses, particularly exemplified in private equity, but it doesn't have to be with private equity. This is I'll just try and quickly explain what we're trying to look at here. This is a model of saying, right, if you've got a business today, so something with a EBITDA 2 million quid. Right, nice business. Let's say it's worth 6 times. So it's worth 12 million quid today. Great business. And over time, it'll deliver an EBITDA of nearly £3 million. So if we use the same multiple, 6 times 2 it was 12, 6 times the 3 might be worth 18 million when you come to sell that business. So nice, it's generated a lot of organic growth. But this is the way the private equity guys will look at it, is say, well, yeah, if I make some acquisitions, They might be smaller businesses, so I might not have to pay quite as much. I might not have to pay 6 times for it on the way in. I might get those a bit cheaper, and they'll grow as well as they go through. I'll do that again, I'll do it again, and suddenly at the end of this, we've got a business that's delivering £6.5 million worth of EBITDA. So we've moved from a single business that would have grown to just under 3 and was probably be valued on the same multiple to a business that's now doing 6.5 times, that's demonstrated to everybody looking at that business that it's really good at growing quite quickly, good at making acquisitions and adding value. And so instead, we get a multiple benefit that jumps up to 10 times. And so instead of a business that would have been worth 18 million quid, we've got one that's worth 65 million pounds by going through that strategic growth through acquisitions. And it's a model that works. Private equity is actually a really successful asset class. They deliver good returns on a consistent basis, and they use this sort of approach to making those investments. What are the key things? If acquisitions is part of a strategy that you might be looking at, what do you need to think about? This came from a survey that was put out of a number of corporate development directors, people who are running the deals in companies. And we're sort of going from the left-hand side of the screen to the right in terms of importance levels. Getting the funding right is absolutely critical. So, like on your mortgage, getting the right investment, whether it's right for you to do an interest only, whether it's right for you to do repayments, but much more complex when you're talking about a business. Getting the financing right is critical. A lot of people talked about regulation. So CMA, so the Competition and Markets Authority, is it going to be something that clears that, doesn't create hurdles, doesn't create challenges from that perspective? Getting things that are demonstrating the flexibility to find the right business, the right structure, work with the management team and the target that you're buying with, making sure there's a good fit on there. So there's a whole series of steps that need to be considered when you're looking at M&A. But as we've seen from the previous slide, it is a strategy that lots of companies are using, particularly if they're backed by private equity, not exclusively, to drive the value of their business higher and higher and higher. So one of that first point was about financing, getting the financing structure right. And this is effectively just showing snapshots and examples of how businesses are funded, as we look from something from more of a debt sort of based through things which are in debt funds, so banks and so on the left-hand side, through funds which are debt funds, which are set up a bit like private equity funds that have to give a return over time to their investors. And they're probably taking a slightly higher interest rate, a slightly higher return than a bank would do, but also can be a bit more flexible sometimes. So again, getting the right structure, the right funding structure. You might find a minority private equity investor, somebody like a business growth fund, BGF, where they're taking a smaller stake in the business, really helping you deliver your end growth. Or you might go for somebody who's looking to buy the whole lot, and you might stay in for a small amount and roll over an investment. Different risk profiles, different structures, but finding the right one for your business is critical. We've just pulled out a couple of examples here of deals. The one on the left-hand side is one that I know personally because it's a business that I sold. It is now a client of Cooper Parry. So we sold this independent governance group. It was called. Sorry, I just got away from the back and I thought, I said something wrong. No, it's 5 minutes to go. So I can even do it quicker than that if we need to. So independent governance group. This is a business that it acts as trustees for pension schemes. Very, very good business. Was making a little over £3 million when we sold the business, and we sold it to a private equity fund, which was LDC, which is part of Lloyds Banking Group. We sold that in November 2020. So over the intervening 3.5 years, the business has grown really, really strongly. The results for this year will come out at about 12 million EBITDA. The run rate, so the effective, if they'd normalised with everything that they've done, the acquisitions they've done, the new clients that they've won, the way they've built that business up, it would be more like 15, 16 million EBITDA. That is a fantastic growth strategy, drive, and a good supporter of that business in LDC. We've helped that growth strategy to deliver growth. Several acquisitions, small ones and quite a sizable one as well as part of that journey. But it demonstrates the journey that they've been on and the way that they've approached building value. RSK, much bigger business, but again has gone through not just one round of private equity, but about 3 or 4 different rounds of private equity before going onto the market. All of them focused on acquisitions as part of that growth strategy. And that was really what I wanted to just cover today. There are different strategies about growing your business, but the part that M&A can play in that to drive growth and deliver value when it comes to exit. So at this point, I'm going to hand on to Candice in our outsourcing team. So I'll pass on.